This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to the show. We got lots to chat about this week. We've got national housing figures from the Canadian Real Estate Association. Going to walk you through those to let you know exactly what's happening, not only in the data, but anecdotally in the housing market. What's happening with these banks going down in the U.S., how it's impacting bond yields as well as mortgage rates, and where you can actually go and save lots of money on your mortgage in the coming weeks. I'm going to give you some insights on that. But, let's start things off here with the Canadian real estate data that came out for the month of February. Sales, remember, February was pretty much like your peak of last year. That was pretty much in all metrics. You saw this exuberance, this blow off top. So when you're comparing to those figures, you're going to have some pretty wild variations here. So you had sales down 40%, big 4-0 year over year, huge move, obviously. If you look at sales now from a historical basis, right, let's go back and look at every single February over the last 10, 15, 20 years. It was a historically slow, weak month of February. Fewest number of home sales since February of 2009. Of course, that's just after the global financial crisis. So, that's basically our baseline. That's our comparison. So we just beat 2009. So really tough month for sales. But you have to ultimately look at the flip side of that too. We can't talk about just sales. We also have to talk about, inventory, new listings. So new listings trickling in at their lowest levels since February 2003. So a 20-year low in the number of new homes hitting the MLS system across the country. So it really gives you some context, right? Imagine how much our population has grown over those years. Imagine how much new building, number of homes that we've added to the overall stock. So this simply just looks at the raw number. Tell me how many listings came to market, not seasonally adjusted, not adjusted for population, not adjusted for housing stock, just the raw number. And it was the fewest since February of 2003. So nobody's selling their homes. Why is this happening? Well, it's not just a Canadian phenomenon. It's actually happening across the U.S. And if you look at U.S. housing inventory, it's at some of the lowest levels on record. In fact, you're seeing all these media reports saying, where are all the houses? Where are all the people? And so, there are some common dynamics at play here. I can tell you sort of anecdotally, the conversations that I'm having and the discussions that we're seeing on the ground in the housing market. Again, these things are hard to predict. This is not something I had, predicted coming into the new year here that we were going to see, multi-decade lows in inventory. But the conversation we're having today is basically there's a lot of uncertainty in the markets right now. There's a lot of uncertainty in the world. There's a lot of uncertainty about, hey, if I list my house on the market, what price am I going to get? Not only that, but when you go to sell, you need somewhere to go. And typically people that are selling are going to go and buy somewhere else. And so usually what most people do before they list is they start looking on the market. They start going to open houses. They start checking out the MLS system and saying, wow, there's really nothing for me to buy. So why would I put my house in the market? I don't want to sell and then have to go and rent somewhere for 2, 3, 4, 5 months, go get an Airbnb because I can't find anything to buy. And so this is some of the challenge that people are having. I think that, the sudden shock in interest rates has kind of frozen the system. If you think about like a move-up buyer, right? Let's look at a move-up buyer in Canada. If they're going to move up, they have to take on new debt, right? Like a lot of people are going to increase the mortgage. They're going to take on more debt to basically upsize, right? So if you're going from a condo to a house, you're probably going to take on a larger mortgage. Well, that means you basically have to pass a stress test at 7%. And you got to pay an interest rate of about 5% today. And so for a lot of people, they're running the numbers and goes, I don't know if I can afford to really upsize. And what's interestingly enough is like a lot of people that are in their houses today, they don't necessarily qualify. They don't qualify for them today. What I mean by that is people that bought 4, 5, 6, 7 years ago when there was no stress test, when prices were really low. If they had to basically reapply to buy their house today, given the prices and given the stresses, they wouldn't qualify. So the market is kind of just it's stuck. It's stuck, and so it's actually a really horrible market for realtors like myself, mortgage brokers, lawyers, people that are involved in that space. Because you think about it, like there's no transaction turnover, there's no churn in the industry. You're having very little low sales, 10-year lows, 20-year lows, and new listings. So there's just not a whole lot to do in general. But the product that is in fact coming to market, if it's in the right price bracket, i.e. entry-level single-family detached house, which is always in hot demand, always in short supply, those houses are getting multiple offers because there's no selection. And people that are buying are generally people that need to buy. They're young families. They want to get on with their lives. They've been looking for a house for 6 or 7 months, waiting for prices to come down. They're tired of their search. They want to get on with their lives. These are people that are transacting in the market, and they're typically competing in multiple offers on a lot of that product. Now you see softness in other parts of the market. The higher end luxury market still slow. You're seeing some softness in larger 2-bedroom condos downtown Vancouver that might have geared towards younger families in the past, or even investors. The investor base isn't really back to what it used to be, given that the numbers just simply don't pencil these days. Again, and you think about someone that's even selling, you're going to look, say, I'm going to go and sell and then go and rent. I mean, the rental pool isn't that great either. There's very, very little supply of rental inventory on the market. So just in general, you kind of have this like frozen market. And I think, you can certainly blame rates going up by 400 basis points in the span of less than 12 months, which just kind of shocked that system. So, long story short is we've seen this big drawdown in Canadian home prices, down 15.8% on a year-over-year basis. That's the steepest decline since the index was created back in 2005. The typical home across the country, again, I know we don't necessarily have a national housing market, but if you take the price of a typical home using the HPI, the home price index, you are down 130. The typical home basically has lost $130,000 in value. So this has been a relatively steep housing market correction. Like I said, the steepest that we have data going back to 2005. I understand there was obviously a massive run-up coming into this, so people can sort of adjust their lens. But the reality is it's a pretty steep sell-off. And we're now seeing prices starting to firm up. And that's not because you have this insatiable demand that is just, wanting to get back into the market. There's certainly an element of that, but the bigger story here is the lack of inventory on market, and that's ultimately supporting pricing right now. And you can see that the HPI, the home price index, took its first uptick in about 9 or 10 months. So again, whether it fades and rolls off again lower here, we'll wait and see. But if I think we're going to get into that in just a few minutes here. But if you kind of walk through the rest of the data, again, national housing, the HPI down 15.8%. The Toronto housing market, which I think you can argue has had the largest run up over the last 5, 6, 7 years, they're down the most, 17.7% on a year-over-year basis. Here in Vancouver, down 9.2%. And Ottawa down 13.9%. So it's really Ontario that's getting smacked around. That's bringing a lot of the national index down. If you look at the one outperformer, continues to be Calgary plus 1.8. I expect that market to actually roll over and go into negative territory, likely in the next month or two. But it's overall probably one of the strongest and most stable markets. But this kind of leads me to the next point, because everyone's saying, okay, well, now what? You've got the Bank of Canada's on pause. You've got banks in the U.S. blowing up. We're talking about, bailouts for some of these regional banks. Is it going to spread? Is it contagion? So the bond market is obviously repricing what central banks are going to have to do. Banks going insolvent is ultimately deflationary. So you're going to have these deflationary shock. You can see oil prices now rolling over as people start really expecting this recession to accelerate again. Regional banks, again, going under is not necessarily bullish or optimistic for the economy. So you're seeing these sort of deflationary forces in effect. Obviously, central banks probably not going to have to raise rates as much, and thus bond yields are now collapsing. So the one that we've been focusing on a lot is the Canada 5-year bond yield. That's down from about 3.5, 3.6 just a couple of weeks ago, down to about 2.8% now. So we're starting to see very few of the banks starting to cut their mortgage rates. But that's it's a 60, 70 basis point move in the span of a couple of weeks. I mean, the bond volatility right now is quite literally off the charts. So if you're, one of these Canadian banks trying to price out your fixed rate mortgages, they're looking for some sort of stability, right? So that they're basically slow to react, slow to cut rates. They're baking in a bit of a risk premium right now, but the rates are going to come down. They're not going to come down as much as they should, given the economic outlook, given the volatility in rates markets. But they are going to come down. We've got some lenders right now. I can tell you, if you are about to close on a property in the next couple weeks, if you're about to refinance or whatever, I highly encourage you to go check out TD is offering a huge promo. They're basically undercutting everyone by 20 to 30 basis points right now, which is pretty unprecedented for the industry. So TD Bank undercutting everybody. If you're looking to save, couple $100 a month on your mortgage, your monthly mortgage, TD's got the promo rates going right now. But I suspect some of the other big banks are going to get in on the action as soon as next week. Again, it might only be 10, 15, 20 basis points, but it'll make a difference. You should see pretty much all of your fixed rates coming down below 5% next week. And if they don't, they'll get there very, very soon, assuming rates hold up here in the 2.8 range and potentially even moving lower. So again, what a sudden change that has happened in just a week or two. And this is what I want to remind everybody is, like, it's really hard right now to figure out where the ball is going over the next 3, 6, 12 months from now. I think anyone that tells you that they know exactly how this is going to play out, like I said, coming into this year, I know a lot of this channel didn't expect 20-year lows in new listings, didn't expect 20% of mortgages in Canada to basically be allowed to defer and tack on this negative amortization on their variable rate mortgages. Didn't probably expect some of these regional banks to suddenly go bust in the night, pretty much out of nowhere. We knew something was going to break, of course, at some point, but it's really, really challenging to figure out, okay, well, obviously lower mortgage rates is bullish for the housing market, but if this regional bank mess continues to spread, you'll see a jump up in unemployment, people losing jobs, and of that nature. And so it's really just managing what could be a potential contagion. So long story short, to sort of summarize the housing market here, in the very, very near term, you're going to have housing supply and demand is going to basically play out in the very near term over the next 1 to 2 months. The supply picture is not going to change. So you're going to continue to operate in a supply constricted environment, which means like it's pretty tough for a lot of buyers to go out there and actually negotiate, aggressive prices when sellers have basically no competition on the market. So that's sort of the very, very near term outlook we have a pretty good view on. As you start pushing further out, it becomes, very much more challenging to have any sort of conviction. My conviction personally is that I said this before, I still think rates are coming down. It's clear the system is struggling to function on these higher rates. Now, I think that obviously the economy and the economic data, I think, is going to continue to roll over. We've talked a lot about rents on this channel being a lagging indicator to the shelter component. There's a great chart out from rentals.ca showing asking rents in Canada finally have rolled over. They've rolled over for 3 consecutive months. Something that I've been talking about for a while, letting you guys know that the rental market actually peaked. It actually peaked last summer. The highest rents achieved in most markets in Canada were actually achieved last summer, and since then they've come off a little bit. So again, not to say that rents are going to continue to fall from here, but what I am saying is they already have peaked, and that's finally showing up in asking rents as posted on rentals.ca. So as always, I hope that helped. See you next week.